Morning guys, Joel Frank here, market analyst for YouTrading, and this morning we're taking a quick look at spot gold prices. Now, as you can see, since the end of June we had this rally from the mid 1700s, but since we sort of hit this 1800 area, we haven't really moved that much. Like we had, 15th of July, I guess we hit this high here just above 1833. But as you can see, for most of the rest of the time, in fact, I'll draw a box. For most of the rest of the time over the last couple of weeks, we haven't really strayed more than around $15 above the 1800 level, or about, $10 below it. So yeah, this support level that I've got marked up here, 1790, is pretty key at the moment, and then I would say that resistance in the sort of 1815, 1816 area will be fairly strong. And then if gold prices were to push higher, well, then you've got here in blue the 200-day moving average. That'll be decent resistance. It was back here on the 20th of July, and then just above that you've got the recent monthly high around 1830, and that actually coincides with the 50-day moving average around, like I said, 1830. So gold's been quite rangy. Why has gold been quite rangy? Well, you've had two conflicting forces going on. So remember that gold has a negative correlation to the US dollar, which has been, for the most part, gradually strengthening over the last month. Why has the dollar been strengthening? Well, it's kind of a mixture of, number one, the Fed turned more hawkish in mid-June, and that's actually what this spike lower was. So that has been weighing on gold, and you can see that gold hasn't been able to reclaim its pre-June FOMC level above 1850 since then. But then at the same time, we've had globally real yields falling, and there was a lot of attention yesterday because US 10-year TIPS yields, which is the real yield on the US 10-year bond, hit a new record low. I think 2 days in a row, actually, it's hit these new record lows now. Remember that gold has a negative relationship to real yields, because the lower yields are, the lower the incentive to hold gold as a safe haven asset, and the higher the incentive to hold gold as a safe haven asset. So these two things have been moving in opposite directions, keeping gold in a range, but the range potentially could be broken this week because we do have a key event coming up. We've got the next FOMC meeting. As I said earlier, just now in the video, this was the last FOMC meeting. It was hawkish. It triggered that reaction in gold. So potentially we could see these ranges broken. If we get more hawkish vibes from the FOMC, we could see another pushback lower towards the end of last month lows around 1750. If it's more dovish, however, we could push to the top of this range, and potentially even on back to those pre-June FOMC levels. Is it going to be dovish? Is it going to be hawkish? That is the big question. I personally think the tone of the meeting might err a little bit more on the dovish end, because number one, concerns have been rising about the resurgence of the pandemic globally because of the Delta variant that's been spreading pretty much everywhere, including in the US. So the Fed might be a little bit worried about that, the effect of that on the prospect for global and US economic growth. Number two, the hawkishness of the last meeting, hawkishness, not really a word, but we got the hawkish vibes at the last meeting because the dot plots were hawkish. That was one of the key reasons. Well, there's no dot plots this time, so that's one sort of source of hawkishness removed. And another source of hawkishness at the last meeting was that Powell sort of confirmed that the Fed is talking about tapering. Well, we're not expecting an official announcement on the tapering timeline at this meeting. I mean, most analysts and Fed watchers think it's still way too soon for that. So that's two potential sources of hawkishness that might not be there. Expect Powell to reiterate his transitory inflation narrative, and yeah, I think that it might be a little bit more dovish, which might be supportive of gold if it hurts the US dollar and if real yields continue to remain suppressed. But anyway, that's just what I think. Hope you enjoyed the video, guys, and I'll see you all in the next one.